Hey, good evening, everyone. Thanks for joining on a long weekend. That shows that you are interested to learn some new things and make your trading more profitable. So, one major issue with options trading, or most of the retail traders, the common mistake they do is when we buy calls or puts, if you are a full time trader, if you are completely focused, eh, we can make money. But if you are working in some IT job or if you are going here and there, if you're not able to enter or exit on time, you may lose the profits. Right? That is the most common problem with most of the retail traders, because trading is like a side hustle. Right? It is not their primary. There are very few who do trading as a primary thing. Mostly they will be in a main job. So that's the reason I wanted to, right? Even though we have 85, 90%, because some traders say that, oh, we missed entry, we missed exit, I was in a meeting, or so that's where I wanted to share this strategy where there is much more, right? You don't need to sit before the system throughout the day. You can spend 1 hour every day in the morning or at the end of the day, and you can make the consistent profits, 80 to 90% profits with less amount of time before the system. So, what is the approach? The approach, right? Basically, I told many times there are stock mainly moves in three ways, right? One is stocks can go up. Second way is stocks can go down. Third way is stocks can go sideways. Right? After a big move, they will move in a sideways for some time, for next 1 hour, 2 hours, 3 hours. Again, they will move up or they will move down. Right? They will go in a trend. Again, they will go in a consolidation. They will move. Again, they will take rest for some time. Again, they will go in a trend, either uptrend or downtrend. So if you are a buyer of calls or puts, let us say you are a buyer of calls. Only if stock moves up, you will make money. If stock goes sideways, you lose, or if stock goes down, you lose. Let us say you are buying some naked puts. If stock goes down immediately, you will make money. But if stock goes sideways, you lose. If stock goes in the opposite direction, you lose. That means as a buyer of naked calls or as a buyer of naked puts, you have one out of three chances to make money. Right? Two times there is a possibility to lose, especially if you are not watching the system, not watching the alerts for entry and exit on time. There is 67% chance you may lose, 33% you may win. If you are focused, if you are watching the chart or if you are watching the alert, if you are taking trades on time, there is a possibility, but otherwise there is a high chance of losing, right? As a buyer of calls or as a buyer of puts. Because if stock goes sideways or if stock goes in opposite direction, in both the ways you will lose. Then the other way, right? If you are a seller of calls or seller of puts, you have 66% chance of winning. But the problem is, again, there is an unlimited risk, right? Because if you are a buyer of call or buyer of puts, only the premium you are paying is at risk. But you are selling some calls or selling some puts, you are you have, right, suddenly the stock goes completely in the opposite direction. You thought stock will go down, but suddenly Tesla starts going up, right? Because of some good news or something. Let us say it goes 20, $30 suddenly, or Apple tomorrow it may go $5, $10 up. Tesla also there is a high potential on Tuesday it may go up. So that is the problem. If you are a seller, you have more chance to make money, but you have also unlimited risk. That is the risk if you are doing a naked, if you are selling naked calls or if you are selling naked puts. So there is a strategy called as verticals or credit spreads, where you have nearly 75% of chance of making money in every trade you take, right? Because in a credit spread, in a verticals, you are a buyer, you are also seller. You are acting as a buyer, you are also acting as a seller. Initially, you are a seller, right? Major part you are a seller, but also you have a hedge, right? You are also, so you are eliminating the risk of unlimited risk, right? As a seller, you have more chance to make money, right? If you are just a seller, you can make 67% of chance to make money, but you have unlimited risk. That's why you are not only a seller, you are also acting as a buyer in the by taking credit spreads. So if stock price goes up, you can make money. If stock price goes down little bit, you can make money. If stock stays choppy, you can make money. So there are a lot of ways you can make money when you take these spreads or verticals rather than, right? Again, I'm not saying that you should not take calls or puts, but if you are a focused trader or if you are a full-time trader, buying calls, buying puts also, we can make money. We can, right? You can make higher rewards, but if you are a trader who is more, right, you can spend only half an hour, 1 hour, 1.5 hour per day. Then what I suggest is you focus mainly on bull put spreads or spreads, right? Bear call spreads, where even though, right, you may not enter at exact time or you may not exit at the exact time where we provide the alerts or where we ask you, still you can make money. That is the advantage. You don't need to be exactly on time to take the trades. You can be little delayed. You can be, right, working only 1 hour a day, but still you have a higher chance of making profits by taking these spreads. So as I said, right, if you buy a call, immediately it should start going up. Then only you'll make money. If the stock goes chop sideways, if stock goes down, you will lose. If you are a put buyer, it only if it starts going down immediately, quickly, you will make nice money. Otherwise, you will lose. But with a spread, right, with a credit spread, you can make money in different ways. Even if stays choppy, it stays at the same price also, you can make money. If it goes up also, you can make money. If it goes down also, you can make money. So there are high chances for you to be successful, and you don't need to keep watching the screen throughout the day. You have limited loss potential because you have a hedge here, right? You are not taking unlimited risk. If you sell naked calls or naked puts, you have unlimited risk. If you buy calls or buy puts, you have a limited risk, but you have higher chances of losing money if stock if you don't take action on time, or if you are not a focus trader, if you are not a full-time trader, or you think like, oh, it may go a little more up, let me wait for some more time, suddenly there can be a big drop. That's what will happen with naked calls or naked puts. So again, spreads, many people think, oh, spreads means something complex, but it is not like a wheel strategy or something or butterfly. It is a simple strategy, right? Vertical spreads is very, very simple strategy. Everybody can easily learn and easily apply it, and they can make nice profits every day, every week. So again, there are mainly two types of credit spreads, right? One of the credit spread is called as a bear call spread. The second one is called as a bull put spread, right? Both are credit spreads only, right? When do we, so what we do as part of spread, basically we are primary a seller, secondary a buyer, right? We are acting as a seller and also as a buyer. Initially, we are, right, mainly, let us say you are like 65% seller, you are 35% buyer. So again, if you think about insurance company, right? I also enable the chat. If anybody want to put your answers, you can put it so you can remember. So let us say you have an auto insurance company. Uh, who do you think makes more money? Whether the insurance company will make more money or whether the people who are buying the insurance will make more money? Because you may be paying only $100 per month. If something happens, you are right. The insurance company will cover your car for 20,000, 30,000, 40,000. But who do you make more money at the end of the year or end of the month? Who has more advantage? Right, the insurance company, right, the company, because based on the quantity, right, out of, if they are selling a policy collecting the premium from 1,000 consumers or 10,000 or 100,000 consumers, There might be only 1 or 2% who may be involved in some accidents, who may get into some issues, who may have, right? If it is health insurance, only 1%, 2% may have some health problems. If it is a life insurance, only 2% may have some issue problems and pass away. So overall, insurance company is profitable. But again, from individual point of view, you are mitigating the risk, right? There is nothing wrong buying the insurance, but the insurance company or the sellers are at a profit overall, right? As I explained earlier, out of three scenarios, if stock moves up, then only you will make money as a buyer. But if stock stays choppy or if stock stays down, the company will make money. That means just like, right, if you go to a casino, generally if you go and play roulette or anything, generally the casino has more chances to make money based on the overall quantity. In the same way, in trading also, as a seller, you have more chances to make money. So that's why, as part of this credit spreads, you are primarily a seller. You are right out of, even though you are doing a buying part, but mainly your focus is to sell. To hedge your risk, you are doing a buying, right? So if you think some stock is bearish, right? Let us say, I'll show you some different examples which can happen on Tuesday, right? I'll also show you examples, you will understand clearly. But if because of various reasons you think some stock will go down, then what we'll do? So generally what most of the retail traders will do, whenever they think like some stock will go down, they will buy the puts. But we know that when you buy the puts, you have only one way to make money. Price should immediately start dropping. But uh, right, when a stock is going down, instead of buying puts, what we can do is we can do something called as a bear call spread. You can buy a call option and you can sell a call option, right? You are initially selling a call option, collecting the premium, and then as a hedge, you are also buying a call option of a higher strike price, right? We'll see with some different examples for the same expiration, right? For example, let us say you see some stock tomorrow as bearish, then we can sell and sell a call option and also buy a call option. So it is a bear call spread. That means you are bearish about the stock and you are selling the call and also buying a call for the same expiration date but at different strike prices. Let us say you are bullish about a stock, right? Because of different reasons, you think like some stock will go up. A retail trader, normally what he will do is he will buy the calls. But if he buys the call, again, as I said, if he is a full-time trader, if he can focus, he can make good profits. But if he is not a full-time trader, instead of buying calls, the best thing is doing a bull put spread. That means he is bullish about a stock. He is selling a higher strike put option and buying a lower put option. That is the way even stock, right? Let us say he is bullish about a stock, but suddenly stock moved up and started right in a consolidation. That means it is just going up down in a small range. It is just moving. Still, he will make profits. Or he was bullish about the stock and stock moved. He will make nice profits. Let us say stock went little bit down than what he bought. Still, he will make profit. That is the advantage. When you do the spreads, you have 75-80% of the time you will make money. There is only less chance if you use a proper position size and out of you take 20 trades per week. If you are winning 16 to 17 trades, then you will be profitable at the end of the week, right? Because you are you have higher chances of success at your side, right? As a seller, as a primarily a seller with a hedging, you will make nice profits, right? Is everyone clear, right? Basically, You are not just doing naked calls or naked puts. If you are not a full-time trader, instead of doing naked calls or naked puts, you are primarily acting as a seller, but you are also doing a buying as a hedge, right? Because as a seller, you have unlimited risk. If you just do naked, if you just sell naked calls, if you just sell naked puts, there is also a high risk. So that's why to protect, to mitigate that risk, you are also buying a call or put as a hedge. In that way, there is a high chance of making profits, whether stock goes choppy, whether stock goes up, stock goes down, right? And if that stock stays in between that spread, there is a high chance of making money. We'll see different examples, and but any questions until this point? Everybody knows about, right? Everybody knows about buying calls or buying puts, but I want to show you some examples also so you understand better. So let me show you some examples so you can understand the concepts much better. Let me take some example like this. So just first of all understand, generally price moves in a cycle, right? It won't keep going up, it won't keep going down. Generally, right, this is called as our discount area, right? That means it is generally where the big players will try to buy the stocks. This is where it is like a premium area. This is where they will try to take the profits. They buy the stock here, they sell the stock here and take the profits. So, for example, let us say Netflix is somewhere here, right? Or let us take some other example like Groupon. GPN. So, if you are in a higher time frame, right? If you are in a 5 minute time frame, you have to close your trades immediately on the same day. If you are in a 30-minute time frame, that means you have more time, right? Maybe next 7 8 candles of 30 minutes, the trend will stay in the same direction. So your signal strength is much stronger. So let us take an example like GPN or Netflix, where stock moved all the way from the top to the bottom. This is like your support, this is like your resistance, this is your discount area, this is your premium area, this is your midpoint. So when stock is at the bottom, you are bullish about a stock. When stock goes and touches the top, you are mainly bearish about a stock, right? That means there is a high possibility for stock to go down, right? Again, this is based on one of the indicators, right? For example, we have something called as cap 11, which has different tickers, right? It is looking at mRNA, WAB, BADU, right? VST, some different tickers. It is looking at all those tickers, and then it is telling that okay, out of all those tickers, these are some tickers which are, if some sticker is at the in green color, right, that is our first focus, right? For example, Tesco, TSCO, right? Let us go to TSCO. So if you see here, the Tesco stock came all the way down from the top, it came to the bottom, right? So it touched the premium area and then it started going up, right? So our indicator is telling that Tesco is a good one. It is overall a bullish stock and it is at a bottom. So number one, right? Your checklist, 1 point is done. Okay, we can see that it came down, started going up. Now, if you see here, right, this line, it was bearish all the way, started going up, it turned green. So number two, that means We got confidence number one, we got confidence number two. Then you have ultimate D indicator, right? That was red all the way. Now you got a green. That means it is telling that it will go up. Then you have one more indicator. It was at the top, it came all the way down. Now it came all the way down. That means it can go up. So you have confidence number three, confidence number four. For example, now I want to see something like price pulse, right? It is telling that there are a lot of buyers here, right? Nearly 11,000 contract. And it is also telling your trend is bullish, your RSI is bullish, right? All these are green, green, green. So it is telling that overall there is a high possibility for this stock to go up. If I want to look at one more indicator, right? You can see that there is a strong support, right? Last time when price came and touched this, it went all the way up. So even if stock, let us say, even if it comes down, it may come down and then it will start going up. This is a strong support area. So now there are so many different indicators, so many different things are giving us the same picture that this Tesco can start going up on Tuesday, right? Because Monday is a holiday. So they are telling us there, right? If you see this ultimate, it is telling that okay, it will go up. Now we got a green, means buy. It came all the way, right? If you see, it came all the way. Now touch the green, it may start going up. So it is also giving us a confidence. This is also giving us a confidence, right? All this time red, 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 red. You got a green, you got a confidence. So now everything is giving us the same picture. So now you can, right? One thing we can do is you can buy the calls. Here you can see it is bullish. So one way you can make money is you can buy the calls. You can buy 270 call or something. So if stock goes to 275, 278 by coming Friday, you will make good profits. But if stock stays choppy, right? Let us say it goes here and stays in a consolidation zone, right? What do you mean by consolidation, right? For example, here, right? It was just moving up and down, up and down, up and down, right? Nearly for entire, right? This is like a consolidation zone, right? It was in a small range, right? Let us say if I just add some swing, so you can see that, uh, right? Just for your understanding purpose, right? This is like a consolidation zone, right? It is in a small box, just moving up and down in the box. So if stock continues to go in a consolidation, if you buy the calls, all your premiums will lose because of the theta decay. But now we are bullish about the stock, right? Because number one, number two, number three, number four, and then you have beta algo, you have price pulse, everything is giving us an indication that this stock will go up on Tuesday. So one option is if you are a risky trader or if you are a full-time trader, if you can right manage your trades quickly, enter and exit on time, then yeah, you can buy the calls. You can buy 270 call. There is a high possibility for this stock goes right to go all the way to around 275 to 280, right? This is where you have the resistance again. So it can go to 278 or 275. But if you want to take low risk, right? You don't want to take high risk, what you can do, you sell the 270 put and you buy 265 put, right? You are somewhere around 267. You are buying $2.5 up. That means you will collect the premiums. You are selling a 265 or something, right? You are selling a 270, you are buying a 265. That means overall you will collect some nice premiums. That means you are collecting the money. If stocks goes above 270, all by the coming Friday, all that money is yours. Whatever you collected, right? You are acting like an insurance company. If insurance company is collecting the premium and if nothing happens to your car, all that money is theirs. right? In the same way, you are collecting premium from a buyer, right? Buyer is thinking price may go down. He is buying a put. You are selling the put. And if the price goes above 270, you may collect some $200 per contract, $300 per contract. If stock goes above that, all that money is yours. If stock goes below, right? If it stays here, all that money is yours. If it goes little bit below also, again you have a strong support here. It will touch this and again it will bounce. Right? As long as stock stays somewhere here, right? Only problem is if it drops so much, you will have a loss. But if it goes little bit down, if it stays choppy, if it goes above, you have full money is yours, 100% profit. If it stays here, you may make 50, 60%. If it goes little bit down, you may make 10%, 20%. Only problem is if it goes all the way below, right? Again, you have a strong support here, support here. There is very, very less chances unless there is some major bad news about the company. Very, very 5 to 10% chance the stock can go down, right? Or suddenly some war happens or something, right? Otherwise, this Tesco stock can go all the way and you can collect the premiums. And you, right, all you need is 5 minutes on Tuesday morning. You see that, okay, right, in the pre-market also, you may see stock moving up. Then you basically do a bull put spread. You sell 270, you buy 265, and then if stock goes above 270, by end of Friday, if it is above 270, all that money is completely yours. Whatever you collected, right? What you are telling that person is, you are telling him that you will buy the stocks from him at 270, even if stock goes down, right? By selling the contract, right? Why we are buying insurance from the company? Because the insurance company is telling that even your car goes to zero value, we'll buy it at 20,000, 30,000. In the same way, you are selling the insurance, you are collecting the premium by telling him that, okay, even if stock goes below 270, I'll buy it 270. And you are collecting $2, $3 per stock. That means your break even is 267, 266 like that. But if stock goes above 270, all the money is completely yours. If stock stays here, all the money is yours. If stock goes down, most of the money is yours. Only problem is if it goes much below, that is only where you have a risk. Otherwise, 75 to 80% you can make profits. Right? Let us look at one more example. PHG. Right? You can see that stock is also in the green color. So PHG, right? Overall, it is a bullish stock and it is in the green color. That means this indicator is telling that this PHG will start going up. So again, as you see, the stock went all the way to 30.7, again dropped on Friday, again trying to bounce now. So if stock is in a range as of now, if it stays in the range also, you'll make money. If it goes till here or here also, you'll make money. If it is right, for example, you will buy 30 put and you will sell 30.5 put. If it goes above 30.5, all the premium collected is yours. And there is, right, again, your ultimate D buy, your T2 indicator buy. If you look at the price pulse, you can see that there are nearly 9,000 contracts by the big players like banks and others. They have a big buy order here, right? They are ready to buy. So if one big player starts buying, then you will see another big player will do another major buy order, another major buy order. So it can go all the way minimum until 30.45 or 30.5 minimum, right? Again, there is only 2,000 sell orders here. It can go all the way to around this resistance, like that, right? So this is where we can do the, so if it is showing in the green color, we can do the bull put spreads, right? You buy a lower put, you sell a higher put, and you collect the premiums. So if stocks, and you don't need to worry, right? Again, next 1 or 2 days, you don't need to keep looking at the chart, right? It will, if it goes all the way up, all the premium, right? As you give, right, your time, as it takes more and more time to go up, you will be at advantage, right? As a seller, you want stock to move slow, right? As a buyer, if you are a buyer of calls, you want stock to quickly go up. But as a seller, time decay, theta decay will be at your advantage. If stock is staying choppy, you will be at more profits, right? You want stock to slowly go up. All right. If it goes quickly up, also it is good for you. Even if it goes slow, also it is good for you as a seller. Right? That is the advantage when you do a bull put spread. You don't need to keep looking at the charts for every 5 minutes, 10 minutes. You can do a bull put spread for Tesco. You can do it for PHG, and you can confidently, because not just one indicator, you have 4 5 different indicators are giving you the same story, right? That is where you can do bull put spreads, collect the premiums, right? You only spend 10 15 minutes on Tuesday morning to take the trades. You can even put a automatic order for your profit booking also. Whenever, for example, you are collecting, let us say, $2 per stock or $200 per contract, whenever it starts going, the value of that will start going down, right? So you can buy back at $100. That means 50, you made 50% profit. You can put your stop loss, you can put your target when you enter the trade itself. So you don't need to keep watching, because there is 90% chance this stock will go up. There is 90% chance Tesco will go up. Right? In the same way, let us look at some more examples. Let us look at some examples where it can go down, right? So let us say CMG can go all the way here and then start dropping. So yeah, let's look at the GPN. So the stock, right, our indicator is telling that GPN is bearish and it is in the orange color. So our first priority is green, second priority is orange. So for example, if you see GPN, it went all the way up, and there is a huge sell order block here. There is a previous day high. There is a resistance. Your ultimate D is in the sell. This one turned to red, but again turned to green. Again, it can turn to red, right? Again, it is not immediately ready for a sell, but there is a high possibility on Tuesday we may see it touching this, and then it will start drop again. Whenever it touches this, whenever this green line turns to red and price starts dropping, you can do a bear call spread, and you can, right, price will come all the way down here again. You can collect all the premiums by selling a call. So this is one way, right, where you can, right, look at the indicators. The indicator will tell you, right, you can ignore the red ones and blue ones. The main ones are green is your number one priority. If it is green, you will do a bull put spread. If it is orange, you can do a bear call spread, right? You are not just depending on this indicator. You are also looking at beta algo, you are looking at swing or price pulse, you are looking at ultimate. When multiple indicators are giving a similar signal, you will have more confidence. Your success will be 85 to 90%. And you don't, all you need is 5 10 minutes to enter the trade. That's it. You don't need to keep watching. You will collect the premiums by next day morning. Again, you spend 1 hour. Already you would have made 30, 40%, 50% gains on the premium. So let me show you a few more examples. Let us take something like RC Capital, right? Because you can only give few stocks, right? You cannot, if you give too many stocks in one indicator, it will throw errors, right? Performance issues. So that's why we can give 20 to 30, right? For example, Pfizer, right? Anything in orange that is good for, let us look at Pfizer. So, right, Pfizer is in the orange color. And you can see that, right, it came all the way to the bottom. There was a huge buy orders. Now there is a sell order block. Here it is at the top. Here it is close to, right, because connecting and then we will get a red signal. So whenever price touch this, then again we'll see a drop. Right, minimum it will come until here or it may come back all the way to 28.74. So again, if you are a full-time trader, you can buy the puts. Otherwise, you can, whenever you are bearish, you can do a bear call spread. If you are bullish, you can do the bull put spread. Let us look at one more example. Right, let us. Right, with every indicator, we can give 30 to 40 stocks. So all you need is 5 minutes before the market. You can know like which are the opportunities for the day. Right, for example, Palo Alto, PAN W, ADI. They are in orange color. Nothing is in the green color. If you look at PAN W, right, it is at a proper resistance now. Right, it moved all the way. Right, we did a bull put spread last week. We made huge profits. Right, we did some 350 to 355. It moved for choppy and suddenly it moved up. We made nearly 100% gains. Whatever premiums we collected, all the premiums we collected. So, right, because we got somewhere here when it was at the bottom, we got it and then it moved. Now it moved all the way from, right, from the bottom, from the discount area, it moved to the premium area. Right, it touched the resistance and then again trying to go down. So there is a high possibility for Palo Alto to drop. So whenever this line turns to red, this line turns to red, then you can do the bear call spread in the same way ADI. Now again, right, touch the support, went all the way to the top. Now it is the previous week high, previous day high. You have a strong resistance here. So this indicator is telling. So whenever this turns to red, this turns to red, this turns to red, you can do a bear call spread. So let us look at some example for bullish ones. S&Ps. So S&Ps, right, from the resistance, it came all the way to the bottom, right? And now it is trying to bounce back. This, you got a buy signal here. This turned to green. And if I go to beta algo, you have a strong support here. You got a strong buy. If I go to price pulse, you can see some buy orders here. You can see some fair value gaps here. That means a lot of buyers are stepping in. So if you do a bull put spread on this one, right, minimum it can go all the way to $530. That is where you have some sell order blocks. So you buy some, you sell 525 puts, you buy 520 puts. That $5 spread, right? You are selling a higher put, buying a lower put. If stock goes to 530, all the money collected is completely yours. Like that, you are. So this is right. One indicator is giving us which tickers can move up or which tickers can go down. and then get SNPS. It is in the green color, right? Bullish, green color, currently around 519.84. So there is a high possibility, 90% chance the stock will go up. Again, if you buy the calls, also you can make money, but you have to be a full-time trader because suddenly it may go up, suddenly there might be a big drop. So you have to make sure. Otherwise, as a low risk, you do the bull put spread, then you can make profits, right? For example, MDLZ or SO. Let us go to MDLZ. So MDLZ is in the orange color. That means the indicator is telling that the stock can go down. You can see that it is the previous week high. Previous week high is always a strong resistance. You see there is a huge sell order block. There is a big fair value, red fair value gap, right? And it went all the way to the top. Now ready to drop again. So there is a high possibility for this stock to drop, right? From the support, from all the way to the from the bottom, it went all the way to the top. Now there is a high possibility for this MDLZ to start dropping, right? So you do a bear call spread, you don't need to keep watching, right? Next day morning, you see if stock drops somewhere here, you make nice profits. You collected the premiums, you sold the call, you bought a higher strike call, and you if the stock drops, right? Again, you have beta algo, you have a huge resistance here. Then you right previous week high is a strong resistance. So like that, you are not just depending on one, but multiple are giving you the same signal where your success rate can be very high, where you don't need to keep watching. Just to do a bear call, and then you can right you sell some 71 call, you buy 72 call. The premium collected, the difference is right. If stock goes down, that is all the premium will be yours. Next day, 30-40% you will make profits, and you can close the trade. And this is one way, simple way, where you use this just to watch one time frame. Right? I'm just watching 30 minutes time frame because next to 34, right? Next to five candles, six candles, seven candles, it may keep going down. So you don't need to keep watching. If it is 5 minutes, you have to keep watching right continuously. If you are doing in 30 minutes, it is more like a swing trade. Right? It may come all the way somewhere to this point, $71. Next 3-4 hours, it will keep dropping. So the other way is right instead of just depending on one time frame, you can do it on two different time frames. Right? For example, okay, now let us look at example of GM, right? General Motors. It is telling that it in the 5 minutes it is in the premium zone. In the 30 minutes also it is in the premium zone. Right? That means for quick scalping you can make profits. For your swing trading also you can make profits, right? It is at the top. 5 minutes it is at the top. In 30 minutes also it is at the top. You can do scalp or you can also do swing trade. There is much more higher chance of success when in 5 minutes it is AJG, right? Let us look at AJG. So you can see that it is at the top in 5 minutes. Now let me, so in 30 minutes also it is at the right. AJG is at the top in 30 minutes. It is also at the top in 5 minutes. So that means, right, immediately it can drop because 5 minutes it is at the top. And again, you can always look at, okay, beta is telling there is a big resistance here. Your price pulse is telling there is a previous week high, right? That means last week high will be always a stronger. In case if it goes little bit up, there is a previous day high and there is a big sell order block. So your chances, right, once you do the bear call spread, because you are bearish about the stock, it moved all the way. In 5 minutes it is at the top, 30 minutes it is at the top. So it will start dropping. The same way GM. Right? Again, it went all the way, right? It touched the bottom, went all the way to the top. Now it will touch this and start dropping. You do a bear call spread, again, it will come all the way minimum till 49.6. Again, you will look at confidence of others to decide if that is a good trade or not. But like this, you can, let us look at FedEx example. So what do you think can happen, right? FedEx, I think FedEx is, right, okay, FedEx is in the premium zone. In 5 minutes, it is in the premium zone. In 30 minutes also, it is in the premium zone. Chipotle is in premium zone. Overall, it is bearish. You can see the red color background. You can see red color background. Overall, the stock is in the bearish trend and it went to the top. So if something is bearish and if you can sell at the top, that is the best possibility, right? You can see it went all the way to the top. Here it went all the way to the top. Touch the resistance, it will start dropping. This went all the way to the top. We may see a red button on a Tuesday morning. It will. So now you do a bear call spread. All the right. If it drops all the way to the bottom, right? Even if it stays choppy, you make money. If it drops, you will make money. If it goes little bit high, also you will make money. Right? This indicator is telling it will drop. This is telling it will drop. This is telling it went all the right. Overall, it is bearish. For example, if I look at 1 hour chart of FedEx. This is like the top, came down, went, came down. Again, it may come all the way down. So like this, again, you can look at, okay, beta algo. There is a strong resistance. Last time it went there, came all the way to 293. Again, it went there. Again, it came down. Again, it went there. You have a strong resistance here. So your indicator is telling your 30 minutes, 5 minutes, it is in a premium zone where sellers can sell it off. So this is good for your scalping, good for swing trading. and your beta algo is giving the same indication that there is a strong resistance. Your price pulse is also telling there is a previous week high, right? So previous week high can act as a strong resistance and can drop. You can see that it also went all the way to the top. That means again there is a reversal point. So now Tuesday morning, 5 minutes, you open the trade. Again Wednesday morning, you take the profits. That's it. You don't need to watch throughout the day. Like this, right? That is the advantage with the credit spreads. Where if you are bearish about a stock, you do a bear call spread. If you are bullish about a stock, you do a bull put spread. And then next day morning, you come and you take the profits. Right? You spend only half an hour, 1 hour at the market open, and again next day market open, you book the profits. So if outside means right, it is this is the premium zone, this is the mid zone, this is the discount zone. If it is somewhere here, that is like outside, right? It is not in when this is your point of interest, this is your point of interest. If your 5 minutes is here, 30 minutes is here, that means it will go up. If 5 minutes is here, 30 minutes is here, it will go down. But if it is somewhere here or here, you don't know, right, whether it may go up, go down. You want to wait for price to touch this zone or touch this zone. That is where if it comes to this zone, bull put spread. If it goes to this zone, bear call spread. If it is somewhere here, you can wait for it to come. So out of thousands of stocks, you will have always 10, 20 stocks every day where they are at premium, right? For example, if I go to um, GSK, Z, right? Okay, this is premium. If both are in discount and in green color, that is the best opportunity. If both are in premium and in the red color, that means it is a bearish and they are at the top, right? For example, if I look at GSK, it went all the way from the bottom to the top. Now, if I enable beta algo, there is a resistance here. So it may go a little bit up and then start dropping. Whenever it goes touch this and I see a red candle, it went all the way to the top. It is trying to create a red dot. So that means I can be ready, right? I can put an alert here whenever price comes to this point, and if I see a red candle, I can do a bear call spread. Like that, there will be 10 to 15 opportunities every day where you can do bull puts or bear calls. If you see anything in discount, right? As I said, stocks like Tesco, PHG, SNPS, they are good ones for bull put. GSK or GPN. Uh, Then TMO, right? Let us look at TMO. Right, TMO may go all the way till this 618 zone. It is here. It will touch this and then start dropping. Whenever it touch this sell order block, it will start again, come back all the way to this. So whenever price goes there, we'll do a bear call spread. Or if you're a full-time trader, you can buy the puts. But again, if you don't want to spend a lot of time, every day, just the first 1 hour, you watch, right, where whichever are premium, you can do the uh, if premium in red color. Let me share the screen. Right, this is one where we just use 130-minute time frame. If something is in the green color and the and it is in the third discount area, that is the number one priority. We can either buy the calls or you can do the bull put spread. If something is in the premium zone and the color is orange, you can buy the puts or you can do the bear call. Like this, that is our number one, number two priorities. Or if you are using a multi-time frame analysis, right? You are not just looking at 30 minutes, you're also looking 30 and 5. That means immediately it will start dropping. Right? Well, sometimes when you do 30 minutes, it might go a little bit up, little bit down. It can, you may get panic, right? Because 30 minutes means it is a high, huge amount of time. Within that 30-minute candle, there can be a lot of up and downs. Whereas here, your 5 is also, if both are discount and your background is green, that is our number one priority. Right? Either uh, you can buy the calls or you can do a bull put spread. If both are in the premium and your background is in the red color, you can buy the puts or you can do a bear call spread. Like that, you don't need to spend entire day. All you need to do is spend first 1 hour, watch the opportunities which are like that. Then you can take and you can make nice profits without spending a lot of time before the screen. Yeah, that's it, everyone. Again, you already have a spread, right? That is the advantage when you do a bull put spread. You are doing along with a hedge. So 90% chance it will go here and start dropping. Even if it goes little bit up also, you'll make money. Again, there is a huge strong resistance, right? This is the previous month high, right? This is the previous week high, previous day high. It may touch previous day and start dropping. If not, if it goes little bit up and starts dropping, right? You have time until next Friday. Until next Friday, there is a high possibility for stock to come all the way to 610. So, right, when you buy a put, immediately it should start dropping. If it goes little bit up with implied volatility, theta decay, your premium, you'll be losing your premiums. But when you are doing a spread, theta decay will be your advantage. Implied volatility will be your advantage. Right? As long as at the end of the Friday, if it goes down, you will make money. You don't need to keep watching, oh, is it going down, going down? You don't need to panic. Right? Because you see so much, right? This is your number one confidence, this is your number two confidence, number three confidence, number four confidence, right? If you so each indicator is giving you that confirmation that it will go down. Yet again, there is nothing, there is no strategy which will give you 100% profits, but your risk is minimal, right? You will make 85, 90% of the trades if you make profit. Even one trade, it goes little, right? You are not losing your entire premium here, right? Maybe if you already have a hedge, maximum you may lose, right? If you buy a call or buy a put, you may lose your entire premium can become zero. But here, your risk is also minimal. You have more chances of success. Even if it goes other side also, you will lose only a little amount, right? If you sell naked calls, naked puts, or if you buy naked calls, naked puts, you have a higher risk. When you do a bull put spread, bear call spread, your risk is minimal and you have 85 to 90% chance of success. You don't need to keep monitoring the screen throughout the day. You wait for a proper confirmation and then just take the trade. Right on Tuesday morning, first half an hour, we can look at like, okay, this is looking good, right? Okay, this AGG is it premium. This is red color. If it is red color and premium, uh, right? Mm, so yeah, right. For example, AJG is premium, GM is a premium, and then you look at your, okay, it is red background. 5 minutes is premium. This is premium. That is my number two player, right? Either I can buy the puts or I can do a bear call spread and I can make profits. If something is green and green, discount, both in discount area and the background color is green, that is my number one priority. I can buy calls or I can do a bull put. So that is how you can make 85 to 90% of the trades. And if you use a consistent position size, right, then if you are winning 9 times and losing 1 time or 2 times also, at the end of the week, you will be in nice profits. So if 1 or 2 trades you use only one contract, two contract or certain amount, and suddenly on third trade you use a big position size, and the third trade goes against uh, right. If you win all small trades and you use a big position size on the last one because you won all the trades, suddenly you we get greedy. Right. Let me make more money. We put all the money. That is where most people make mistakes. But if you use a consistent position size, right, because while taking the trade itself, you know what is your highest reward, highest risk. If you use a similar risk for every trade, then 8 out of 10 trades or 9 out of 10 trades you will make money. One trade we may lose. Right? That way again very less chances only if there is some bad news with the stock, because you are not just depending on one. You are looking at ultimately you are looking at T12, you are looking at beta algo, you are looking at price. The scanner is giving us which ones are better. Then whenever you have it, we are seeing that okay, is this also telling the same thing, this also telling the same thing. That is how we can consistently generate income. So already you can go to Right Choice Advisors YouTube channel. I did some sessions on options, basics, and debit spreads, credit spreads. So credit spreads is the least risk, right? Low risk strategy where you don't need to put a lot of time also. So yeah, you can go to this link tree, or you can go to, if you want all the indicators, you can go to ninja underscore apex underscore bot, and you can get the indicators. Or if you want to get just right, if you want to subscribe to options channel, you can go there and subscribe. It is up to you. Right. Again, if you have indicators, right, for example, let us look at NQ. You can use it for anything. You can use for stocks, you can use for options, futures. Right. For example, if I do CF1, so ES is at premium and premium, right? That means 5 minutes it is at premium, 30 minutes also it is at premium. So if I go to ES, so you can see that it is at a strong resistance in 5 minutes. So it went all the way, right? If somebody attended Thursday session, in the evening session, we took some trades. I explained that, right? ES will go all the way from here to here. We drawn the lines. Where is the support? Where is the resistance? You can also watch the recording video. On Friday, exactly, it moved from here to here and then started dropping. So in 5 minutes, it is at the top. If you see 30 minutes also, you have a strong resistance. So you can also do spreads with options using futures also, not only stocks. With futures also, you can do options. You can either buy the puts or, so here there was a huge 85,000 buy order. It touched it, it went all the way to the top. Now you have 8,000 and there is a 10,000 sell order block, previous month high. So right on Tuesday or maybe next in the next few hours, we may see a drop on ES. Yeah, because for futures market, I think it is still up. Market may start or because of holiday. I think yeah, market is moving. But yeah, if you have the indicators, you can use for anything. Crude oil may come to around $73 and then start moving up. Then this came all the way to the bottom. This came all the way to the bottom. Yeah, that's it, everyone. I'll share the recording and whatever we discussed today on Tuesday, you can see the results for everything. So you can choose whichever, right? If you want, if you have the indicators with you, you can use for futures. You can do stocks. You can do India stocks. You can do options. You can do currencies. You can do crypto, right? The price action is same for anything. You can use, right? You can pay 150, 150, 150 for each subscription, or you get the indicators and you use for everything. So it is up to you, right? If you want to learn and if you want to use by yourself, getting the indicators is the best thing, because one trade with futures will make you the $200, $300. Yeah, for indicators it is $399 per month. For options it is 149, or for stocks it is 149, or for futures it is 149. It is up to you. Whichever you want, you can subscribe. Yeah, we are making 85 to 90% success with the options, and we'll continue to make that. We already did lot of free sessions. Even on Thursday also we are sharing every live recording. We took nearly 20 and 18 made profits. Two of them are still open, which may make profit on Tuesday. So we cannot keep giving everything for free. On Thursday we did nearly 4 hour, 5 hour free session. And free doesn't have a value, right? When you give free, you don't take it seriously. When you pay the minimum, you take time to learn, you take time to practice. That's it, everyone, right? Again, you can, yeah, we do live sessions every day. I share all the live recordings on the YouTube channel also. And yeah, every day I explain like why we are taking a trade in the live sessions. I explain, I take the trade so members can learn how to use the indicators and how to consistently make money. Yeah, okay, everyone. Have a nice rest of the weekend and talk to you on Tuesday morning.